All right, let's keep going. Let's see what we have here. First question says, when a company receives the cash from a sale made on credit, what happens? Stockholders' equity decreases. Stockholders' equity increases. There is no effect on stockholders' equity. Revenues increase. Well, what do you think? Well, let's look at choice A, stockholders' equity decreases. Stockholders' equity would decrease through the payment of dividends or through the payment of expenses, but the collection of cash would not be one of those. So A is wrong. Stockholders' equity increases. Well, this is also an incorrect answer because we've already made the increase to stockholders' equity when we made the sale on credit. Now we're simply receiving the cash for it. So we can't increase stockholders' equity a second time. Choice C, there is no effect on stockholders' equity. This is the correct answer. So, again, I want you to understand, when we made the sale on credit, that's when stockholders' equity went up. When we received the cash, cash went up, but accounts receivable went down, and so they just kind of offset each other. All right? So if we read the question correctly, C is the right answer. Next one says, which of the following situations increase stockholders' equity? Choice A says supplies are purchased on account. I think we had this question before, so this will be a review. If you didn't see that video, this will be the first time you are seeing this. Services are provided on account. Cash is received from customers on account, and the utility bill will be paid in months. Well, choice C here is what happened in the question up here in this first question we had, right? Services are provided on account is when the actual increase in stockholders' equity occurs. Okay, when this occurs, we had services are provided on account. So what we would have here is we would have an asset going up, and that's it. No corresponding asset going down, no liability going up. So B is the correct answer. So these two questions here are related. If you can understand both of them, you'll have it figured out. That the total dollar amount of the debits equals the total dollar amount of the credits in the ledger accounts can be verified through A and. Okay? Chart of accounts, trial balance, income statement, and balance sheet. So we have to know what these things are, and if we know that, then we can figure this out. So, interesting thing here, the chart of accounts and the trial balance both list all of the accounts, and they list the accounts in the exact same order. The difference is that the chart of accounts is primarily just that. It's a list of the accounts. You can generally look up the individual account balance for each account in the chart of accounts, but you don't get a final total for all of the various debit and credits. So that's a wrong answer. A is not correct. The income statement only has income statement accounts, and the balance sheet only has balance sheet accounts, so those are wrong. The answer we're looking for is the trial balance. It lists all of the accounts, and generally when we look at the trial balance, it will list all the accounts. We generally have it list all of the accounts that have a balance. And we will have a total at the end that gives us the total amount of debits and the total amount of credits. All right. True false says a trial balance determines the complete accuracy of the numbers. Anytime you see a phrase like this, complete accuracy, you can just about always circle it false. Because we don't know that the amounts for these business transactions that we've analyzed, we don't know to a certainty that we've done all that correctly. We better hope we have. But we haven't necessarily, the trial balance does not determine that at all. It merely determines that the amount of debits equals credits. It requires further analysis to determine anything more regarding accuracy. Okay. Another true false. It says journalizing a transaction with both with the debit and the credit for $69 instead of $96 will cause the trial balance to be out of balance. This is a false statement because it says we're going to debit the transaction for $69, and because it says both, we're going to credit the transaction for $69. So we're going to be, I want you to understand, we're going to be off by the difference between these numbers, which is $27. But we will not be out of balance. We'll be wrong, but we won't be out of balance. Okay? The only way that this could possibly work would be if we had, let's say, a debit for $69, and then we had a credit for $96. Then we would be out of balance. But even then, we would still be in balance because this is the 21st century. We're dealing with accounting software. Our software would merely add a second debit. It would force it, and it would just put it in there of $27. So this is false on all fronts. All right, looks like we might need a calculator. I don't think I have one pulled up. Let me get one real quick. Okay, the accounts in the ledger of Monroe Entertainment Company are listed. All accounts have normal balances. I think we've seen these numbers before, but the previous time we looked at it, it said the total of the assets is this. Now they just want debits. So some of these items are going to be assets and some of them are not. They're just asking us the total amount of debits. All right, accounts payable is a liability. And all liabilities have a normal credit balance, so we're going to put an X by that. Accounts receivable is an asset. And assets have a normal debit balance, so we're going to count that. Prepaid insurance is another asset. So let's go plus 2,000. Cash is an asset, and it has a debit balance for sure. Let me put my check mark by the prepaid insurance and the cash. So plus 3,200. Dividends. Dividends have a normal debit balance. They're certainly not an asset, but the question asks for debits. So we have to include the dividends of 1,200. Let's see, plus 1,200. Fees earned. Fees earned have a normal credit balance. They're over on the income statement. So we're not going to count that. Insurance expense. Expenses have a debit balance, regardless of whether it's a prepaid expense or whether it's an income statement item like insurance expense. So let's go ahead and add that. Land is an asset, and and again, assets have debit balances. So we're going to add the land. wages expense, and expense again. Plus 1,400. And then common stock has a normal credit balance, so we'll put an X there. So our final answer, if I did this correctly, and I just worked through it for the first time, so hopefully I did it correctly, is $13,900. All right, let's go ahead and wrap this video up, and we will finish up the chapter with the next video handout solutions.